America's $38 trillion debt has grown into something far more dangerous than a statistic on a balance sheet. It's become a slow-burning fuse. With annual interest payments now racing beyond $1 trillion, the financial strain is no longer abstract. Entire states are starting to bend under the pressure of deepening economic decline. Housing markets are unraveling, jobs are disappearing, and tax revenues are drying up fast. And when the next recession arrives, it won't stop at Wall Street's doorstep. It will slam into state economies that are already suffocating under massive debt loads, relentless inflation, and shrinking populations. Beneath the polished GDP headlines and optimistic forecasts, the structural weaknesses of the country are becoming impossible to ignore. The cracks are spreading, and some states are far more vulnerable than others. What follows are the 15 states most at risk of falling apart first, as the United States drifts closer to its next major economic upheaval. Number 15. Washington. Long regarded as a showcase of modern prosperity and cutting-edge innovation, Washington now finds itself edging toward a serious financial turning point. Beneath Seattle's gleaming skyline and the tech-heavy campuses of Redmond sits a growing structural imbalance, one that could unravel quickly once the next recession hits with full force. Home prices across the Seattle metro area still linger around $790,000, yet paychecks haven't risen nearly fast enough to match inflation. On paper, a median household income of $97,000 looks impressive. In reality, after accounting for taxes, housing costs, healthcare, and basic living expenses, many families are barely scraping by, with little left to put aside for emergencies or the future. The state's economic engine is also far less diversified than it appears. Washington relies heavily on a narrow trio of industries: technology, aerospace, and shipping. Giants like Amazon, Microsoft, and Boeing alone employ more than 400,000 workers. But those same companies are now tightening budgets, pausing hiring, and increasingly moving production and operations overseas. If a nationwide downturn intensifies, even a modest 10% workforce reduction across these firms could wipe out more than 40,000 jobs, almost overnight. That kind of shock would dramatically worsen homelessness in cities already overwhelmed by a record 52,000 unsheltered residents. Compounding the risk is Washington's lopsided tax system. With no income tax but heavy reliance on sales and property taxes, the middle class feels the squeeze, while state revenues remain highly sensitive to consumer behavior. When spending slows, the impact is immediate. Every single percentage point drop in consumer activity could drain hundreds of millions of dollars from Olympia's budget during an economic slump. From rising mortgage delinquencies to hollowed-out shopping districts, the warning signs are already there. Washington's image of success hides an economy growing increasingly fragile beneath the surface. Once a recession takes hold, tech layoffs, soaring living costs, and unstable tax revenues could converge into a genuine state-level crisis. One that reveals how even America's most admired economies are often propped up by borrowed stability and fragile confidence. Number 14. Alaska. At first glance, Alaska looks safely removed from the financial turbulence gripping the rest of the country. In reality, its economy is among the most vulnerable in the United States. With a population of roughly 730,000, the state leans almost entirely on a single industry: oil. Energy revenues account for close to 85% of Alaska's income, meaning when oil prices stumble, the entire system shudders. That risk became painfully clear in 2020, when crude prices dipped below $40 a barrel, wiping out nearly $1.5 billion in state tax revenue in a matter of months. As global energy demand softens and investment steadily shifts toward renewables, Alaska is staring down a structural problem that no short-term oil boom is likely to solve. At the same time, everyday living costs are relentlessly high. Grocery prices in Anchorage run about 35% above the national average, while heating expenses have jumped 28% year over year. Housing offers little relief, with median home prices hovering near $400,000. Although average household income sits around $86,000, inflation has steadily eroded purchasing power, leaving notably less room for savings or financial breathing room. A recession would only intensify the pressure in a state that has already seen 6 consecutive years of net population loss. Younger workers continue to leave in search of lower costs and better opportunities elsewhere. weakening other parts of the economy along the way. Tourism and fishing, two of Alaska's remaining economic pillars, are both struggling. Cruise ship tourism dropped 40% after the pandemic and still hasn't fully rebounded. Meanwhile, commercial fishing, once a $5 billion industry, has been battered by collapsing salmon populations and tightening export restrictions. Perhaps most alarming is the condition of the state's financial safety net. Alaska's once massive rainy day fund, which held more than $17 billion, has been drawn down to less than $3 billion. If another recession hits, the state could face serious difficulty funding basic obligations, paying bills, meeting pension commitments, or even maintaining infrastructure across its vast and remote regions. For a place so rich in land and natural resources, Alaska's economy is dangerously narrow. If the broader U.S. downturn deepens, this won't look like a mild slowdown for Alaska. It risks becoming a sharp financial plunge, one that further separates the state from the mainland prosperity it once helped power. Number 13. Louisiana. Louisiana is quietly sitting on a financial pressure cooker that's close to boiling over. Even though the state produces roughly 10% of the nation's total energy supply, its residents see surprisingly little benefit. Household incomes remain low, job security is shaky, and economic resilience is thin. The median household income sits near $57,000, while almost 18% of the population lives in poverty, placing Louisiana among the worst-performing states in the country on both fronts. The state's finances only add to the risk. Public debt has climbed past $20 billion, and recurring budget shortfalls continue to widen year after year. In that environment, even a relatively modest recession could force painful cuts to essential services and critical infrastructure. Louisiana's traditional economic backbone, oil and gas, no longer provides the protection it once did. Global shifts in energy demand, along with tougher climate regulations, have already shuttered refineries and petrochemical facilities across the state. Between 2020 and 2024, more than 12,000 energy sector jobs disappeared, and fresh investment has slowed to a trickle. When oil prices soften or export volumes drop, the impact is immediate. State revenues can fall by hundreds of millions of dollars, setting off a familiar cycle of budget tightening that hits schools, hospitals, and public programs first. Layered on top of these financial pressures are Louisiana's growing climate risks. Each hurricane season now carries multi-billion-dollar price tags. Hurricane Ida alone caused an estimated $75 billion in damage, and the coastline continues to vanish at an alarming pace, roughly one football field every 100 minutes, putting entire neighborhoods, ports, and industrial hubs at risk. Tourism, another key pillar of the economy, remains fragile. Hotel occupancy in New Orleans is still about 15% below pre-pandemic levels, while rising crime rates and soaring insurance costs have cooled investor interest. Housing has also become increasingly unaffordable, as home insurance premiums have surged by 63% in just 3 years, squeezing homeowners and renters alike. Altogether, Louisiana's economy rests on unstable footing, overly reliant on fossil fuels, exposed to relentless natural disasters, and weakened by years of poor fiscal management. As the broader U.S. recession takes shape, the state could be pushed into a brutal domino effect: widespread job losses, accelerating outmigration, and a fiscal breakdown that leaves cities and industries struggling simply to stay afloat. Number 12. Arizona. Once widely viewed as a fast-growing land of opportunity, Arizona is now facing what looks more like a financial drought than an economic boom. The state's population has surged past 7.5 million, but that rapid growth came at a steep price. Housing costs ballooned, water resources were stretched thin, and infrastructure spending piled up debt that is becoming harder to manage. In the Phoenix metro area, the median home price has climbed to roughly $435,000, nearly a 60% increase since 2019. Meanwhile, average household income has barely budged, hovering around $74,000. With mortgage rates now above 7%, affordability has cratered, and the strain is showing. Foreclosure filings are up 45% year over year, a clear sign that many households are reaching their breaking point. Arizona's worsening water crisis may ultimately prove to be its most serious economic threat. About 36% of the state's water supply comes from the Colorado River, which continues to shrink at an alarming pace. In 2025, federally mandated cuts to water allocations have already forced restrictions on farms, reducing crop yields and wiping out an estimated $1.3 billion in agricultural revenue. Cities like Scottsdale and Mesa are now openly warning residents about potential future water rationing, an outcome that could sharply depress property values across the state. The job market is also losing momentum. Industries that once powered Arizona's growth, particularly construction and tech manufacturing, are slowing noticeably. Intel's pullback on chip expansion plans, combined with a steep drop in home building permits, down 41% since 2022, is flashing early warning signs of broader layoffs ahead. Retail vacancies are climbing in Phoenix's outer suburbs. Homelessness has risen 31% since 2020, and the ripple effects are spreading quickly. Even tourism, which generates roughly $28 billion a year, is beginning to soften as Americans cut back on discretionary travel. At the same time, Arizona's brutal summer heat, frequently topping 115 degrees Fahrenheit, has made the state less appealing to retirees. For the first time in a decade, new in-migration is slowing rather than accelerating. With an overheated housing market, dwindling water supplies, and heavy reliance on consumer spending, Arizona is increasingly exposed to economic shock. If the U.S. recession intensifies, this desert economy could shift from rapid growth to serious financial distress faster than nearly any other Sunbelt state. Number 11. New Jersey. On the surface, New Jersey looks like one of the richest states in the country. Dig a little deeper, though, and the picture changes fast. Beneath that, wealth sits a mountain of structural debt and a cost of living that's pushing residents to the edge. The state's public debt has ballooned past $240 billion, which works out to more than $26,000 per person, one of the heaviest per capita burdens nationwide. Homeowners feel it immediately, with average property taxes nearing $9,800 a year, while overall living costs run about 15% higher than the national average. When a national recession arrives, the delicate balance between income and obligation here won't hold for long. New Jersey's economic foundation is also more fragile than it appears. The state leans heavily on finance, pharmaceuticals, and real estate, three industries that tend to contract sharply when the economy slows. Office vacancy rates in Newark and Jersey City have already climbed beyond 25%, and a steady stream of companies relocating to lower-cost states has steadily hollowed out local job markets. Even pharmaceuticals, once a cornerstone of the state's identity, have shed more than 20,000 jobs over the past decade due to automation and overseas outsourcing. At the same time, long-term obligations are piling up. New Jersey's pension system is severely underfunded, with liabilities exceeding $95 billion. A downturn in the stock market could instantly widen that gap, leaving lawmakers with few options other than cutting services or raising taxes. Infrastructure only adds to the strain. Over 40% of the state's roads are now rated in poor condition, signaling years of deferred maintenance and underinvestment. Housing is another growing pressure point. Median home prices sit near $520,000, while average rents hover around $2,200 a month, both increasingly unrealistic for households earning the median income of $97,000. As interest rates and insurance costs continue to rise, mortgage delinquencies are quietly inching upward, hinting at deeper trouble ahead. Taken together, New Jersey's high taxes, massive debt load, and dependence on volatile sectors leave it especially exposed. When the next recession fully takes hold, even modest declines in Wall Street earnings or real estate values could set off a chain reaction, one that ultimately leaves taxpayers responsible for financial obligations their state is no longer equipped to handle. Number 10. Indiana. Indiana's economy appears steady at first glance, but underneath that calm surface is a structure that's far more fragile than it seems. Manufacturing accounts for nearly 27% of the state's GDP, one of the highest concentrations in the nation. That kind of dependence becomes dangerous the moment a recession hits. When global demand slows, factory orders can dry up almost instantly. In 2024 alone, Indiana shed 18,000 manufacturing jobs, and analysts warn that another 40,000 positions could vanish if the U.S. slides into a deeper economic downturn. The automotive industry is particularly vulnerable. Assembly plants and suppliers in Kokomo, Fort Wayne, and Lafayette are heavily tied to export markets and supply chains connected to China and Mexico. With trade tensions rising and electric vehicle investment losing momentum, these factory towns could be staring at unemployment rates climbing past 9%, levels not seen since the depths of the 2008 financial crisis. At the same time, the cost of living is rising faster than many residents can handle. Housing affordability is slipping away, with the median home price now around $275,000, a jump of 35% since 2020, while wages have barely moved. Rural households, already stretched thin by stagnant incomes, are being hit especially hard as utility bills and grocery costs have surged 19% over the past 2 years. Even the state government's reputation for fiscal discipline may not offer much protection. Indiana relies heavily on sales and income taxes, both of which fall sharply during economic slowdowns. A revenue decline of just 5% could punch a $1 billion hole in the state budget, forcing cuts to public education, healthcare services, and infrastructure projects first. Ironically, Indiana's long-standing strength, its low-cost manufacturing-driven identity, could quickly become its biggest liability. As factories slow or shut down, small towns lose their economic backbone, property values sink, and local businesses struggle to survive. If the next recession hits with real force, Indiana won't just face job losses. It risks a broader economic unraveling that exposes just how vulnerable America's manufacturing heartland has become. Number 9. Texas. Texas loves to sell itself as recession-proof, but that reputation masks a growing structural imbalance beneath the surface. Its massive $2.8 trillion economy is heavily tied to volatile industries, energy, technology, and real estate, and all three are beginning to show serious stress signals. Oil alone accounts for nearly 15% of state GDP, yet prices have slid from about $110 to $78 per barrel, stripping billions from state and local revenues almost overnight. At the same time, the housing market is flashing mixed and troubling signals. Across Texas, the median home price has climbed to roughly $335,000, up 45% since 2019. But with mortgage rates sitting above 7%, home sales have plunged nearly 40%. In Austin, the warning signs are even louder, where active listings have surged 78% in a single year, pointing toward a potential market correction. Rent isn't offering relief either. In major metros like Dallas and Houston, monthly rents now exceed $1,800, steadily eroding disposable income and slowing consumer spending. Beyond housing, Texas is dealing with a quieter but equally serious fiscal strain. The state's explosive population growth, nearly 1,200 new residents every day, has pushed infrastructure, water supplies, and energy systems to their limits. The 2021 power grid failure, which caused an estimated $130 billion in economic damage, exposed just how fragile those systems are. Despite promises of reform, the grid remains vulnerable. In a deep recession, even modest revenue declines could severely strain utilities and essential public services. Job losses are also beginning to mount. Major employers such as Tesla, Dell, and Amazon have already announced layoffs in the state. If unemployment climbs to just 6%, Texas could see more than 400,000 jobs disappear in a matter of months. Adding to the pressure, insurance costs tied to climate-related disasters, hurricanes, floods, droughts, and extreme heat, are soaring, pushing businesses to reconsider whether staying in the state still makes financial sense. When the next recession fully takes hold, Texas's image of unstoppable growth may crack wide open. An economy built on cheap labor, relentless migration, and energy profits could suddenly find itself cornered by falling oil revenues, a cooling housing market, and financial obligations that are no longer easy to ignore. Number 8. Nevada. Nevada's economy is almost entirely tied to how willing people are to spend money for fun, and that makes it one of the most vulnerable states when the U.S. economy slows. Close to 30% of its GDP comes from tourism, hospitality, and entertainment, most of it concentrated in and around Las Vegas. When Americans cut back on travel, dining, and gambling, this flashy desert economy can unravel with shocking speed. The state has seen this movie before. During the 2020 downturn, Nevada's unemployment rate exploded to 28.2%, the highest in the country. Now, many of the same warning signs are reappearing. In 2025, visitor spending is already cooling, with hotel occupancy down 12% year over year and gaming revenues slipping 8%. Casinos, which collectively employ more than 350,000 workers, have started trimming shifts and postponing expansion plans. In a deeper recession, tens of thousands of those jobs could vanish, setting off another surge in foreclosures, a painful echo of Nevada's recent past. Housing remains a weak spot as well. The state still carries one of the highest foreclosure rates in the nation, and home values have already dropped about 7% from their peak. Outside of Las Vegas, the slowdown is becoming increasingly visible. Markets in Henderson and Reno, once supercharged by Californians fleeing high housing costs, are now losing steam. In Reno, the median home price sits around $565,000, a level that's simply out of reach for households earning under $90,000 a year. As migration slows and borrowing costs stay elevated, construction, another industry that employs roughly 10% of Nevada's workforce, is shrinking rapidly. That contraction ripples through the broader economy, worsening job losses and reducing household spending. Meanwhile, the state's tax system leaves little room for error. Nevada depends heavily on tourism and sales taxes, so when visitors disappear, government revenue falls just as fast. With public debt exceeding $18 billion and growing demands for infrastructure investment, Nevada could be forced into severe budget cuts affecting schools, healthcare, and housing assistance. When the next U.S. recession hits in full, Nevada's glossy image won't hold up for long. The neon glow will dim, revealing an economy built on casinos, tourists, and borrowed money, one where the cracks beneath the desert mirage are already spreading. Number 7. Hawaii. Hawaii's postcard-perfect image masks one of the most economically exposed states in the country. Nearly one-quarter of its entire economy is powered by tourism, a dependence that quickly turns dangerous when the broader economy slows. The fallout during 2020 made that painfully clear. Visitor arrivals plunged by 75%, and unemployment spiked to 22%, the second highest rate ever recorded in U.S. history. Today, Hawaii appears to be drifting back toward that same edge. Tourism is already losing momentum again. As airfare and lodging prices climb, fewer travelers are booking trips. In Honolulu, average hotel rates now exceed $380 per night, while vacation rentals run about $310. A typical family trip to Hawaii can easily top $8,000, putting the islands out of reach for many middle-class households. That drop in affordability is showing up in the numbers, with tourism revenue down 11% so far this year. For residents, the cost of living has become overwhelming. On Oahu, the median home price has soared to roughly $1.1 million, while average rents in Honolulu hover near $2,700 a month, among the highest in the nation. Everyday expenses are just as punishing. Grocery prices run about 67% above the U.S. average, and electricity bills have jumped 22% in just 1 year. When a recession hits, local families have almost no room left to cut back, and many respond by leaving altogether. That pattern is already underway. Hawaii's population has declined for 6 consecutive years, and outmigration continues to accelerate as residents search for more affordable places to live. At the same time, the state's finances remain fragile. Public debt has climbed beyond $26 billion, and government revenue is deeply tied to visitor spending. Even a modest dip in tourism can quickly open massive budget holes. Layer in the fact that Hawaii imports more than 85% of the goods it consumes, and rising global costs only intensify the pressure. When the next U.S. recession spreads, Hawaii won't just deal with fewer tourists. It risks a shrinking middle class, a growing exodus of residents, and an economy that can no longer support the idyllic image it markets to the rest of the world. Number 6. New York. New York sits at the center of America's financial universe, and that position also makes it one of the most exposed when the economy turns south. With an economy valued at roughly $2.6 trillion, the state leans heavily on Wall Street, commercial real estate, and corporate services. When markets stumble, New York feels the impact almost immediately. A relatively modest 10% drop in financial sector earnings can wipe out about $6 billion in state tax revenue, enough to spark sweeping cuts to schools, housing programs, and public transportation. The stress is already visible, especially in Manhattan's office market. Vacancy rates have climbed to 21%, the highest level since 1994, as remote and hybrid work continue to drain demand for office space. In some neighborhoods, commercial property values have fallen nearly 30%, putting serious pressure on the city's $60 billion property tax base. During a recession, that gap could grow beyond $8 billion, forcing layoffs of public employees and deep reductions in city services. At the same time, the cost of living keeps climbing. Median rent in New York City has reached about $4,200 a month, while the average home price across the metro area hovers near $740,000. Inflation has made it harder even for high-income professionals to keep up. More than 40% of residents now spend over half of their income just on housing, a level that leaves little room for savings or financial shocks. Not surprisingly, people are leaving. Since 2020, more than 650,000 residents have moved out of the state, taking both tax dollars and workforce talent with them. Retail vacancies in Manhattan have climbed past 18%, while small businesses struggle under some of the highest operating costs in the country. Layered on top of all this is an enormous fiscal burden. The state carries roughly $390 billion in debt, along with pension liabilities that exceed $300 billion. That combination turns New York into a financial powder keg. When the recession deepens, layoffs across finance, real estate, and tech will ripple outward, shrinking the tax base and undermining the state's already fragile recovery. For decades, New York symbolized American economic dominance. In the next downturn, it may instead illustrate just how quickly that dominance can erode. Number 5. Delaware. Delaware may be tiny in size, but financially, it's standing on some of the most unstable ground in the country. With fewer than 1 million residents, the state's economy is overwhelmingly dependent on corporate registrations, finance, and banking. Exactly the sectors that tend to collapse first when a recession hits. More than 60% of Fortune 500 companies are legally incorporated in Delaware, yet the vast majority don't actually operate there. That creates a dangerous illusion of stability. When financial markets slow, Delaware's revenue can evaporate almost instantly. By 2025, corporate filing fees and franchise taxes accounted for roughly 41% of the state's total revenue, a level that leaves little margin for error. If companies begin downsizing, restructuring, or shutting down altogether, the impact would be immediate. A single downturn in corporate activity could remove as much as $1.5 billion from the state budget, pushing Delaware into deficit almost overnight. This vulnerability isn't theoretical. During the 2008 financial crisis, business filings fell 38% in just 1 year, delivering a brutal shock to state finances. At the household level, pressure is mounting as well. The median home price has climbed to about $390,000, a 47% increase in 5 years, while average rents in Wilmington now top $1,700 per month. For a state with a relatively small labor force, just 500,000 active workers, even modest job losses hit hard. If a national recession trims employment by only 2%, Delaware could lose around 10,000 jobs, roughly the economic equivalent of wiping out an entire small city. Trade adds another layer of risk. The Port of Wilmington, a key hub for agricultural imports and chemical exports, is feeling the effects of slower global shipping and weakening international demand. As exports decline, related industries and logistics jobs face mounting uncertainty. Rising insurance premiums and healthcare costs are squeezing families further, leaving even middle-income households increasingly vulnerable. Without a diversified economic base or a broad tax structure to fall back on, Delaware's reliance on paper wealth and Wall Street-driven profits makes it especially fragile. When the next recession arrives, the state could flip from budget surplus to fiscal crisis in a matter of months, proof that small economies can sometimes fall the fastest and the hardest. Number 4. Maryland. Maryland often looks financially secure on the surface, boasting a median household income above $98,000, one of the highest figures in the country. But much of that wealth is tightly clustered around the Washington, D.C. metro area, leaving the state heavily dependent on federal spending. When a national recession triggers budget cuts, hiring freezes, or contract reductions in Washington, Maryland feels the shock almost immediately. Nearly 30% of all jobs in the state are tied directly or indirectly to the federal government, and the private sector simply isn't strong enough to absorb a sudden pullback. That weakness has been building for years. Manufacturing employment has dropped 20% over the past decade, while small businesses struggle under some of the highest operating costs in the nation. At the same time, Maryland's financial obligations continue to grow. State debt now exceeds $40 billion, and pension liabilities are expected to increase by another $5 billion by 2026, further tightening the state's fiscal flexibility. Housing, once considered a stabilizing force, is beginning to show stress. The median home price has climbed to roughly $445,000, and average monthly mortgage payments have jumped 38% in just 2 years. In counties such as Montgomery and Prince George's, mortgage delinquencies are quietly rising, particularly among middle-class households that bought homes at the market peak in 2021. Meanwhile, Baltimore, long considered the state's economic backbone, is facing serious challenges of its own. Crime, population decline, and business departures have taken a heavy toll. Since 2020, more than 20,000 residents have left the city, and downtown office vacancy rates have climbed past 28%. Even the Port of Baltimore, which moves over $80 billion in trade each year, has seen exports drop sharply as global demand slows and automation reduces labor needs. Maryland's reliance on federal employment and an overheated housing market leaves it especially sensitive to economic downturns. When layoffs hit Washington or federal contracts are trimmed, the ripple effects spread quickly, draining consumer spending across local communities. Despite its reputation for affluence, Maryland is far more fragile than it appears, and one serious recession could undo decades of carefully balanced but increasingly vulnerable prosperity. Number 3. Illinois. Illinois is a textbook example of a state living on borrowed time. Its finances are already stretched to the breaking point, even before factoring in the next recession. The state is carrying roughly $60 billion in unpaid bills and more than $140 billion in unfunded pension obligations, meaning it's effectively insolvent on paper. Unsurprisingly, Illinois holds the lowest credit rating in the country, sitting just one step above junk status. Every economic slowdown pushes it closer to the edge. The trouble is especially visible in Chicago, the engine that drives the state's economy. Commercial real estate vacancy rates have climbed beyond 23%, while downtown property values have fallen about 35% since 2019. As those values sink, so does the tax revenue the city depends on. At the same time, rising violent crime and a steady stream of corporate departures are accelerating the decline. Major employers such as Boeing, Citadel, and Tyson Foods have already moved operations elsewhere, taking tens of thousands of high-paying jobs with them. Homeowners across the state are feeling the squeeze as well. Illinois has some of the highest property taxes in the nation, averaging around 2.1%, second only to one other state. While the median home price sits near $295,000, annual property tax bills often exceed $6,000, making it increasingly hard for families to stay. Since 2020, more than 340,000 residents have left Illinois, shrinking the tax base just as state costs continue to rise. Industries that once provided stability are also weakening. Manufacturing, long a cornerstone of Illinois' economy, has shed about 15% of its jobs over the past decade. Logistics centers around Joliet and Rockford are slowing as consumer demand softens, further eroding employment. With inflation still cutting into wages and unemployment creeping toward 6%, the state is stuck in a dangerous cycle, falling revenues, growing debt, and accelerating outmigration. Illinois' heavy reliance on borrowing to fund pensions and public services only amplifies the risk. In a severe recession, additional credit downgrades could shut off access to new loans altogether, forcing widespread layoffs and deep service cuts. Illinois isn't waiting for a collapse. It's already unraveling in slow motion. When the next recession fully arrives, that gradual bleed could turn into a full-scale economic breakdown, redefining what state-level financial failure looks like in America. Number 2. California. California was once hailed as the fifth largest economy on the planet. But today, it's teetering on the edge of what could become a historic economic breakdown. Its massive $4.5 trillion economy is heavily reliant on real estate, entertainment, and technology, three sectors that are all now pulling back at the same time. In Silicon Valley alone, more than 90,000 jobs have disappeared since 2022, as giants like Meta, Google, and Tesla slash payrolls and cut billions in costs. In San Francisco, office vacancy rates have surged to a record 36%, hollowing out downtown districts and draining critical property tax revenue, leaving parts of the city eerily empty. Housing, once California's greatest symbol of wealth, has turned into one of its biggest liabilities. The statewide median home price still sits near $760,000, but with mortgage rates hovering around 7% and insurance premiums skyrocketing, affordability has sunk to its worst level in 4 decades. Home sales have plunged 45% from their 2021 peak, while foreclosures are up 31% year over year. Even traditionally insulated areas like Marin County and Santa Clara County are seeing listings pile up with few buyers willing or able to step in. The population trend is just as alarming. California has lost residents for 4 consecutive years, with more than 800,000 people leaving since 2020. Businesses are following close behind. High taxes, heavy regulation, and rising operating costs have pushed companies out of the state. Major firms such as Oracle and Tesla, along with dozens of mid-sized tech companies, have relocated operations to states like Texas, Nevada, and Florida. According to IRS migration data, this corporate and individual exodus has already resulted in an estimated $56 billion loss in taxable income. All of this is feeding directly into a growing budget crisis. State officials recently acknowledged a staggering $68 billion deficit, driven largely by collapsing income tax revenue as high earners move away. At the same time, California is grappling with worsening homelessness, now exceeding 180,000 people, record-high insurance costs, and persistent water shortages that threaten the agricultural sector. The outlook for the Golden State has rarely looked this bleak. When the next recession intensifies, California won't just experience an economic slowdown. It risks a broad unraveling of its inflated housing market, its shrinking tax base, and even its long-standing identity as America's ultimate success story. Number 1. Florida. Florida's economy, long powered by sunshine, tourism, and non-stop growth, is now sending off unmistakable warning signals. Beneath the glossy image of packed beaches and luxury condos, the state is balancing dangerously close to an economic tipping point. Tourism, responsible for roughly 25% of Florida's GDP, is already starting to fracture. In 2025, hotel occupancy has dropped 18%, air travel is down 22%, and international visitation has fallen nearly 30%. Even the seasonal influx of northern retirees, once a reliable source of spending, is drying up as inflation, soaring rents, and crushing insurance costs make extended stays unaffordable. Florida's once red-hot real estate market is also cracking from within. The median home price now sits around $410,000, but the real shock is insurance. Property insurance premiums have exploded by 68% in just 2 years, averaging roughly $6,000 per home annually. Thousands of homeowners can no longer afford coverage, while major insurers continue pulling out of the state altogether. Foreclosure filings have jumped 39%, and housing inventory is swelling across areas that once seemed untouchable, including Tampa, Fort Myers, and Orlando. The state's rapid population growth is compounding the problem. Florida has been adding close to 1,000 new residents every day, yet its infrastructure simply isn't keeping up. Power grids, water systems, and transportation networks are buckling under the strain. Rising sea levels now threaten an estimated $2.9 trillion in coastal real estate, and hurricane-related damages have doubled since 2015. Hurricane Ian alone inflicted roughly $13 billion in losses, underscoring how exposed the state has become to climate-driven disasters. Job security is tightening as well. Construction, hospitality, and retail, industries that together employ more than 40% of Florida's workforce, are beginning to shed jobs as demand cools. Tourism-dependent communities such as Key West and Panama City Beach are already reporting record numbers of business closures, a troubling signal of what's ahead. In a full-scale recession, Florida's economic model, built on tourism, real estate speculation, and retiree savings, could unravel faster than anywhere else in the country. The beaches will still be there, but the promise of effortless prosperity that once drew millions may be swept away, replaced by mounting debt, repeated disasters, and a growing sense of disillusionment.